let's first talk about your old 401k. So your old 401k, that's with Charles Schwab. Is that in a IRA or is it still in a 401k?
It's still in the 401k. I literally just paid off that loan maybe last month.
Cool, awesome. So 173,000. You paid out the loan, so that means you took out the loan when you were still working for the company, correct?
Yes, when I took out the loan,
Okay.
I just pulled out the money, paid cash to the card, and then just paid myself back.
Okay, yeah. Because the reason why I ask is because, like, typically you are not able to take out a loan on a old 401k. But for you, since you took it out when you was with the old company, it's fine. And we actually recommend people, when they are about to leave a company or they're about to retire, we recommend them to take a loan against their 401k. The reason why is for that reason, because if you roll it into an IRA, which is fine, but once you take the money out of an IRA, you have to pay taxes at 20%. And then also, if you're not 59 and a half, you got to pay an extra 10% penalty. So if you know you're going to need money, right, or you're doing something from an investment standpoint, it's better just do a loan against the 401k, have it sit like in a money market account, whatever, then use that to kind of fund your dreams per se, instead of doing a withdrawal from your IRA. So you actually did a good deed by actually doing a loan compared to taking the money out your IRA. So your new 401k, how much is in that?
I think roughly about the same.
So 169. And how long have you been with your company for?
Be 4 years next month.
Okay, 4 years. Okay, cool. And did you check with them to see if they have any restrictions on taking out a loan? Okay, and they have no restrictions. So that means so you already took a loan of 7, so now you're just doing the rest. Definitely make sure you're gonna get the 1099 every year from them showing the interest that was paid. Make sure you give that to your tax professional, whether it be me or whoever the case may be, because that's a tax deduction. The reason why is because you're going to do what you call a loan agreement. So you're going to get the money, because the money's personal. So then with that, then you're going to use that money to then pay for the mentorship, if I'm not mistaken, correct?
Yeah, and put money away for the research loan. We have to touch on whether research mortgage, pay how the utilization and probably put money.
Anything that's going to be used towards business. So the mentorship, so like that's going to be used towards business. Then anything else is be used towards business because it's going to you personally, the 401k loan. So then the 401k loan, and I would actually say take out all 43,000 to be honest with you, because again, it's only 7%. It's 7% is money that you're not going to pay taxes on. You get the money back, and then with the income that you're going to get with the group home, you're going to be able to easily pay that back off. So I would actually say take out the whole 43,000. I wouldn't say 30. Me personally, I would say 43. And then also think about it, like, so if you're paying off debt, and let's say you have like your debt has an interest rate of what? So they're at least 14%. Then I mean, maybe 10% at the low, but they're over 7%. I would imagine because they're credit. Let me ask you a question: would you rather pay your 401k company 7% and get it as a write off, or pay Wells Fargo 14% and don't get a write off? That's why we say take out the total amount. We want to pay down all those, so that now you have less interest you're paying, and then the interest that you're now paying, you get to write that off from a tax deduction standpoint. So again, like I would say take out off 43,000, me personally. I would say take out 43,000. So after we take out the 43,000, then we want to make sure, it's very important, you want to make sure that you take out a loan, and the loan is from you to your business. So you're giving yourself a loan. The reason why is because if you ever get audited, it won't show as income as if you pay yourself, as in your business, money to run a business. And then you got to pay taxes on that. So you want a loan, you want to create a document, or if you retain us, then of course we'll create it for you. But you want to create a loan document that basically says that you are loaning, you as a person, you are loaning X amount of dollars to your business. And then when you do that, you have to put an interest rate, and it could be as low or it could be as high as it needs to be. And so I would say, since you're paying yourself, just do it like at 0.001%. Yes, let's say you're going to use $30,000. That 30,000 is going to be the money that you use for the mentorship you're going to do to basically acquire the property. from a closing standpoint. So now, you now just pay yourself, as I said, a loan. So basically, Gaia Holman is paying GNC Solutions payment, 5-year loan, payment of 0.001%. So let's say $1 a month of interest, a loan that you have to pay back over a certain amount of time with no prepayment penalties. So now there's no prepayment penalties as you're making the $3, $4, $5,000 a month with the group home. Now you're quote unquote paying yourself back the loan. Now at the end of the day, it ain't like money's leaving because it's your money. Just like when you loan, if you loan yourself money, like, so it's not like money's going anywhere or you got to do something special. No, you just need documentation to make sure if you ever get audited, you're doing things correctly. So again, like I said, create that loan agreement. Or again, if you retain us, then we can definitely create that for you. That's that. When you pay the mentorship as well, you want to pay the mentorship out of your business, not out of your personal, because from a tax deduction standpoint, right? This is tied to the business, so now it's a tax deduction. Your personal paying mentorship personal really can't justify that write-off if we're paying something out of our personal for mentorship. We don't have a business or any business activity. You paying for education, you paying for growing your business as business activities. So now when the income that you receive is offset by that mentorship that you're paying. So I would say you want to have 3 business bank accounts for your LLC, for your business. One business bank account is just for income. So when the money comes in for the group home, comes into that one account. And then you have a second bank account at the same bank for expenses. So things that are leaving your pocket expense wise, it only comes from that account. And then the third account is for savings and taxes. So that means that your quarterly taxes that you have to set aside is now being set aside in that account. And when you pay taxes for your business at the end of the year, you're not robbing Peter to pay Paul. You're not having to get money from one place to another. It's already in that account. And if I'm doing my job properly, as if you retain us from a tax professional standpoint, because we're doing things throughout the year to have tax deductions, you might not have to need and use all that money. So now the money that you have is really play money that you get to use to grow the business, to buy another group home, right? To pay for services. Because you're not using that money from a tax standpoint. And percentage wise, I recommend for every $100 that comes in, you keep $10 in that income account. 70% or $70 goes to the expense account, and $20, just 20%, that goes to the taxes and savings account. Yeah. So by doing it that way, you're kind of budgeting without budgeting, right? Because since you're giving yourself set parameters of how much you should spend and how much is going into that bank account for you to spend, it's going to make sure that you don't have or pick up bad spending habits because you're making extra money because you already have that 70% allocated already. So we'll take the $43,000. We're going to pay off the loan. We say you had a loan of $7,000, or I thought it was about $10,000. I would say just continue to pay that down month to month. Don't worry about paying it off. And then, of course, once we start getting some of that group home income coming in, then use the group income money to pay that off, right? Because theoretically speaking, since now you have business income that's now passive, let's have our passive income pay our bills, not your active income. You see, your active income, that's the money we should use to pay off our personal debt and to grow our personal money from a 401k standpoint. So our personal income is what we're going to use to now max out our 401k. Our personal income is what we use to max out our HSA account. So that with our HSA account, now we can, so the HSA allows you to do, $5,000 into your health savings account. So now you can use that and have tax-free income for anything medically related. That's a tax deduction because when you put money in the HSA account, it's a tax deduction, right? Now that income we're making allows us to pay down our mortgage. Like that's what that does. Our business income that we're passively making money, but we're making money, that then kind of funds our lifestyle or funds the growth of our business. So now with that extra $6,000 a month. Now, if you want to get out of debt quicker, let's use that to pay down the 401k loan. 5 months from now, the 401k loan is almost paid off, if not complete. Well, 8 months from now, if you're getting $5,000 a month, which is below average. For most group homes, you're going to get about $6,000 to $8,000 a month. I'm saying 5. So I'm underestimating how much you're going to make. So now in 8 months, a 401k loan, because we've paid off more, is paid off. And now we got that full $5,000 a month to do whatever you want to. Now let's have a conversation about that second group home. And this time we got to worry about even better. So we're not making $5,000 a month. We're making $10,000 a month. So now that 401k loan is paid off in 5 months, not 8. So 5 months from now, with an extra $10,000 a month, this is our slush fund that we use to do closing costs for our next group home property. So you're not using your income where you're working to do that. You're using your business income. So your business income is funding your lifestyle and helping grow your business. Your personal income is paying down debt. So when you retire, you're debt free and financially free. So the money that you make passively is going to fund your lifestyle. So that's the current 401k. The old 401k, and of course, you want to roll that over to an IRA with us, of course, because with an old 401k, you can't take a loan against it anymore. It's there collecting dust. It's not being managed because a 401k is self-managed, which means if you don't make any changes, nothing's being changed. So I recommend you roll over to us here at All Truist. I used to clear through Charles Schwab, but didn't like their platform whatsoever. Conversation for another day. So we use All Truist. So we roll over to an IRA with us. The money's going to grow investment wise. And then again, other passive ways to create income, right? Because there's other things you can do outside of group homes, which we'll talk about down the road. We're going to have those conversations, right? If you want to do another loan, then we can set up your own company 401k. Where we will move over your money from your IRA with us to your company IRA that you create when you start making money through your business. And now you can take a loan against your own company 401k to fund some things that you want to do and not pay taxes. So it's so much stuff we can do because you have that flexibility of having that IRA that you don't have today.